Thank you very much. I would like to thank the conference hosts and organizers, including in particular Professor Alpay, the Director General of CESRIC, and also His Excellency President Gül for the kind invitation. It's a great pleasure to be here. I will talk about aspects of a stable and sustainable financial system. And I think it's quite a nicely balanced panel we have here. For instance, including Dr. Turhan, a practitioner from Borsa Istanbul, and just now we've been reminded of orthodox theory by Professor El Gamal. And I suppose, where do I fall in this spectrum? I consider myself an empirical researcher, looking at empirical facts in order to come to scientific conclusions. So let's start with some basics, and I think I can tie in quite nicely with the excellent presentation by Anne Pettifor, who started this panel. I will talk about, very briefly, since Anne has already done a good job on this, the question of where money comes from and what causes the recurring boom-bust cycles and crises. And then, of course, as empirical researchers, we have to ask the question, well, what sort of policy or policies have empirically in the past been most successful in avoiding these cycles and crises? And the empirical evidence shows, of course, we can avoid them. They're not unavoidable. And then what sort of structure, what sort of design of the banking system has been able to achieve that? And in general, well, how can the financial system deliver stable and sustainable growth? Now, I've conducted a survey polling over 1,000 people. This was done in Frankfurt, the city of banks and central banks in Germany, home of the European Central Bank. And so perhaps, there's a bias that the audience was, if anything, a bit better educated, perhaps. So this poll from over 1,000 people in central Frankfurt was as follows. I asked people, who do you think creates and allocates the majority of the money supply? Not in the UK. That needs to be taken out. That was for the UK survey. I'm quoting the bigger 1,000 people survey from Germany. And to make it easier, I gave them options, multiple choice: the government, the central bank, the banks, the capital, money markets, the global financial infrastructure, and others or don't know. And the interesting is this, I think, reasonably well-educated sample gave the following result. 84% of those polled thought that it's those who create and allocate the majority of the money supply is the government or the central bank. I also asked the second question. Well, there were many more, but another question in there was, would you agree with a system whereby the majority of the money supply is created and allocated by private profit-oriented enterprises? The results were even more stark. Over 90% said no. It's like, are you crazy? Was the sometimes implied answer. But of course, the reality. This is UK data now. 97% of the money supply is created by the banking system. It's about the same figure in Germany and very similar in most countries today. If you ask people another question, and of course we've had a financial crisis recently in a few North Atlantic countries, where is money safer? And you give them two options. Start with a stockbroker, the sort of company that trades securities listed on the Borsa Istanbul, for example. So if you give your money to a stockbroker to trade, obviously you have to transfer it to the stockbroker. What happens? What's the status of this money? Two options. It's owned by the stockbroker, once you've transferred it, and therefore if the stockbroker goes bust, it's at risk. Or B, the stockbroker holds it in custody, and therefore if the stockbroker goes bust, the money is unaffected. What do you think? Which one is it? A or B? B, yes. It's a good answer, certainly from the CEO of the stock exchange. Second question, if you give your money to a bank, similar situation, what's the status of the money? A, it's owned by the bank, and therefore if the bank goes bust, it's at risk, or it's held in custody, and therefore it's unaffected by the failure of the bank. Now, there's a sort of expression in various languages, put your money in the bank, it's safe in the bank, or as safe as banks. Obviously, expressions like that have been shaken quite a bit by the crisis. And what's the right answer to this? Well, deposit insurance usually, number one, we're not talking about deposit insurance here, but the legal status. And even with deposit insurance, of course, you usually have a limit, and the money beyond that is at risk. Plus, things may change. Look at Cyprus or some other examples. But which of these two answers is correct? Dr. Turhan gave the right answer to the first question about the stockbroker. With the stockbroker, money is held in custody and is safe. But that's not the case with a bank. When you deposit your money with a bank, they own it legally, and they don't hold it in custody. If the bank goes under, it's affected. And yes, governments have introduced deposit insurance, £85,000 or 100,000 euros in the Eurozone. So yes, we have a certain layer, but that's why we need this layer. It's kind of funny, though, if you think about it, because most people think, well, stockbroker surely is going to be riskier than a bank. Turns out it's the other way around. So what's happening with these banks? Why are they like that? Well, banks create the money supply. How do they do this? When somebody takes out a loan, the bank will pretend that the borrower has paid in a deposit. But neither the borrower nor the bank nor anyone else in the universe has actually paid in or transferred any money into the borrower's account. Perhaps in the quote that Anne Petitfort had in her presentation by Bernanke, he might say, well, we just mark up the number, or mark up the account. Well, the bank creates a fictitious deposit. And of course, nobody's able to tell that it's been fictitious, because the banks are the settlement system of the economy, and most people assume them to be honest accountants. What about other forms of money? There's, of course, cash, but that's only tiny, 3%. What about quantitative easing, the way it's been done by the Bank of England and Bank of Japan? It's an expression I defined originally differently, not the wrong way that central banks have redefined it in the most recent era. Quantitative easing was originally defined as credit creation, but it's become defined as bank reserves at the central bank. What about this bank reserve money? As I've been pointing out in earlier publications than Paul Schurd, of course, that's money that never leaves the central bank, and banks do not lend those reserves. So the money that's circulating, for all means and purpose, is bank credit. Therefore, bank credit creation is the most important macroeconomic variable. And banks are in the driver's seat because they decide how much money to create and who to give it to and for what purpose. And that will reshape the entire economic landscape. And that determines whether we have an asset bubble ahead, a banking crisis, or stable and sustainable economic growth with high employment and no unemployment and no inflation. These are the possibilities. And it's decided by the decisions by banks, bank credit creation. And of course, it's not a market that does that, because the credit market, as even the mainstream researchers have shown and agree, is rationed, and therefore it's allocation, which is not a market result. Now, what causes the boom-bust cycles and crises? It's a very simple story. I set this out in 1992 in the quantity theory of credit. Credit is what's driving the economy. That's the money supply. You have to divide it into two streams. Of course, you can divide it further. That's the starting point. Credit for the real economy is credit for GDP transactions, and that drives nominal GDP, real circulation credit. And credit for non-GDP transactions is financial credit. That is always unsustainable, and when it starts to become big, it always starts a Ponzi scheme, because you're not going to generate income streams to service and repay the loan. You're only going for capital gains, which will look initially very attractive, but it's actually all capital gains, and they're dependent, they're contingent on continued increased credit for financial speculation. When that slows, the house of cards collapses, the Ponzi game is over, the music stops, there aren't enough chairs, bankruptcies in the banking system is quickly bust because, of course, with 10% or even 12% equity, you just need a drop in asset values on the asset side of the bank balance sheet by 12%, and that's it. So, of course, that happens very quickly, but not if banks create credit for productive purposes in the real economy. So the three scenarios. When banks create credit for GDP transactions, there's two scenarios. One is if the money is used for consumption, you have new money creation, but you don't have any creation of new goods or services connected to those. So more money chasing the same amounts of goods and services, you get inflation. That's the left side here, consumptive credit creation, not sustainable. That's, I suppose, best understood. Central banks have to some extent been looking out for that. But we can have credit used for productive purposes, and that will always lead to sustainable growth with no inflationary pressure, because as banks lend for the production of new goods and services and implementation of new technologies and increasing productivity, you will have more real things to back the new money creation that the bank loans imply, and therefore there's no inflationary pressure. If you focus on that, that's how you get high growth. This is what the East Asian economies succeeded in doing by making sure credit is allocated and guided for those productive purposes. Japan did this, Taiwan, Korea, and of course since '82 also China. But if credit is not even used for GDP transactions, but is used for non-GDP transactions, then you have your asset inflation, speculative boom, which must follow by a bust, and it's just a question of size and degree, but it's always the same mechanism, and that's, of course, unsustainable and very damaging, usually, including to the taxpayer. So all the asset bubbles and busts can be explained by this, whether it's the US in the 20s, asset boom driven by bank credit, followed by the bust of the Great Depression in the 30s, or Japan in the 80s, followed by the bust ever since. By the way, the data on the chart on the right side, that's Japanese data, when credit for financial speculation as a share of total credit doubled from 15% in 1980 to 30%. And that's out of total credit, which itself was, of course, rising. So you had just a dominant proportion of credit was speculative credit driving up asset prices, but inevitably turning to bad debts. And the same for the UK, of course. Most recently, you can explain the very predictable crises in Ireland, Portugal, Spain, and Greece, which are due to excessive credit creation. This is under the watch of the European Central Bank. Bank credit expanded by 40%. That's the blue line here, way ahead of GDP growth. And when that happens, you will have asset inflation and, of course, then, as we now see, a bust banking system. So the policy that's been most successful in avoiding these cycles and crises has been, since it's not the market deciding the allocation of credit anyway, it's an allocation decision by the bankers. It's funny that nobody's told the bankers, oh, by the way, since you're doing a very important job here, you are creating and allocating the money supply and reshaping the economy. Please, do this well in a sustainable fashion that helps everyone, such as don't do the dangerous stuff and don't lend for financial speculation, but please lend for productive purposes. Nobody's asking them to do that. But if you do ask them to do that, and there's very simple mechanisms such as the window guidance, credit guidance mechanism used in East Asia, you get stable high growth and no bubble. In the 80s, this mechanism was abused in order to create a bubble, which shows, the mechanism is highly efficient. And of course, that can be done in any country. The other possibility, of course, is to use state money and not bank money. In other words, introduce monetary reform. Why should money be safer with a stockbroker than with a bank? Now, there's an alternative, and that is to shape the banking sector structure. And we've had this discussion links in with the participatory banking system and proposals we've been hearing. In Germany, 70% of banking is accounted for by small, local, not-for-profit banks, which lend most of their loan books for productive purposes and do not engage in financial speculation. And then, of course, you get, as a result, stable growth. And Germany was not, therefore, directly, and its banks were not directly affected. The big banks, the high street banks, which only account for 12% of bank deposits in Germany, of course, they were affected because they were doing the financial games, but not the Sparkassen, public savings banks, and cooperative banks, Volksbanken, and so on. So designing a banking sector structure like this, as is the proposal also for Turkey to increase that, is, of course, a way to do that. And then interest rates can also be reduced, kept at a minimum, or abolished entirely. And that's my last point. Then I'm finished. To summarize, what we can do is to create a network of local small-scale not-for-profit banks that do not lend for speculative purposes and have very low interest rates. I'm involved in an initiative to do this in the UK, where 90% of banking is accounted for by 5 big banks who are the speculators, some have been named, and they don't lend to small firms for productive purposes at all. Big banks want to lend to big projects. So that's an initiative that we do need some support for, and I'd be looking out to talk to you about this. The other policy initiative is to introduce central bank guidance of bank credit. Not just the quantity, but the allocation. A very simple, well-designed mechanism that will get banks on board. So banks want to fulfill the quota and not overshoot. You give them the right incentives, as we heard actually from the finance minister today. You want to incentivize banks to do this, and I think that's quite possible. Thirdly, let's not forget, and there will be more about this tomorrow in the session by Bill Still and Tarek Al-Diwani, monetary reform is possible, because it is possible to return the public privilege to create the money supply to the people to whom it belongs. And that can be done, for instance, by requiring banks to hold customer deposits in custody, so they're safe, and also by allowing local governments to create and spend public money into circulation for productive investments. Then you have a decentralized public money process. And interest can be discarded. Actually, there is a final, very brief slide, as you see. Usury interest is, of course, justified by economists on many, many grounds. We don't have time to go into this. I just mentioned one, opportunity cost. The lender has to be compensated for foregoing alternative uses of the money. But, of course, by now we know that's not true. There are no opportunity costs because banks create the money out of nothing. And I've shown in my work that all the other justifications also do not apply. We don't need interest. It's not the mechanism that drives this anyway. So it's quite feasible to have a system without interest. There's more in some of my publications, such as New Paradigm in Macroeconomics, Where Does Money Come From, and Princes of the Yen, which, by the way, in 2003 warned that the ECB was likely to oversee massive credit bubbles and banking crises in the Eurozone. Thank you very much.